Good afternoon, everyone. Welcome to this joint In Conversation event, co-hosted by the William J. Clinton Leadership Institute and the Long Run Initiative. The William J. Clinton Leadership Institute is the executive education wing of Queen's Management School. And the Long Run Institute is an independent, not-for-profit forum for academics, business leaders, and public policy makers. It provides insights from historical analysis of long-run forces and trends, and it provides context to deepen our understanding of the grand challenges facing businesses and government. It's an alliance between Toronto-based Signal Influence and the Centre for Economic History here at Queen's and at University College London. I'm delighted today to welcome Russell Napier to our fireside chat today. In my office, we have a literal fireplace, so we are actually having a fireside chat today without the fire being on. Russell is the author of the Solid Ground Investment Report for institutional investors and co-founder of the investment research portal LRI, a business he now owns or co-owns with DC Thomson. Russell has worked in the investment business for over 30 years and has been advising global and institutional investors on asset allocation since 1995. Russell is the author of, and I'm just going to pull up his book, The Anatomy of the Bear, Lessons from Wall Street's Four Great Bottoms. It's been described by the FT as a cult classic. And he is also the founder and course director of the Practical History of Financial Markets at the Edinburgh Business School. Russell is also the chairman of Midwind International Investment Trust, which is a £500 million market cap closed-end investment vehicle listed on the London Stock Exchange. And he's a member of the advisory committee of 3 fund management companies. In 2014, Russell founded the charitable venture, the Library of Mistakes, a business and financial history library in Edinburgh that now has branches in India and Switzerland. And indeed, the Library of Mistakes in Edinburgh is expanding and moving to new premises. He is a contributing columnist, and this will be of interest. One, and this is going to be the subject of our In Conversation this afternoon. Russell, really welcome. It's great to have you here in your home city of Belfast. You've had such a fascinating career. Okay, can you tell us, how did a butcher's son from Belfast have a front row seat for the boom and bust in the Asian financial markets in the 1990s?
Yeah, I ask myself that question sometimes because it happened very, very quickly. So obviously that goes through grammar school, through Queen's University, Belfast, and then a job in Edinburgh working for, as a graduate trainee, working for what was in a very small company called Baillie Gifford. Within 5 years of starting that, I was in Hong Kong analysing the Asian stock markets for the entire world, which is kind of embarrassingly quick. And the question is, how could that possibly happen? And the answer is, and actually it comes from your own book, Boom and Bust. There was an asset class that had no liquidity, that suddenly had liquidity, which was Asian equities. And I wouldn't say nobody knew very much about it, but there weren't many people who knew anything about it. So suddenly, if you knew a little bit about it, and I've been doing it for maybe 3-4 years by the time I shipped out to Hong Kong to get this front row seat, suddenly you became an expert. Not that dissimilar to the crypto market we're living through today. It's a new market, it's a fresh market. So you can be an expert in 3 or 4 years because there isn't someone with 10, 15, 20 years experience. So when these markets went from entirely illiquid with very few people following them to suddenly being liquid, then people like me with virtually no experience ended up right in the thick of it in the front row.
Okay, that's fascinating, Russell. And one of the other themes of your life and your career, one of the major emphasis you have is on mistakes. It seems to be an important theme of your approach to finance, to thinking about the economy, to thinking about business. And in your book, The Asian Financial Crisis, it is the story of a huge series of mistakes on the part of investors, on the part of governments. And indeed, the very first line of your book, just to quote here, is, "This is another book about mistakes." And famously, as I said in the introduction, you've set up the Library of Mistakes in Edinburgh now with branches in India and Switzerland. and it's a library which I've had the pleasure of visiting and speaking at. Why do we need to spend more time thinking about mistakes?
So the library is kind of founded on a little phrase from a man called James Grant, who many people watching this will know of, Grant's Interest Rate Observer. And it stuck in my head when I read it. And he said, in science, progress is cumulative, but in finance, it is merely cyclical. And I thought, why? Because first of all, it rang true. Having lived through a few of these things, you think, yeah, I've seen this before. And then if you start reading financial history as a form of education, which I did, because I didn't, as you just pointed out, I didn't know anything about finance, because my degrees were in law. I found a quick and easy way to get to understand it was actually through history rather than through the textbooks. The textbooks were pretty good on the theory, but when I tried to find the practice, you had to look long and hard to find these books. So mistakes, I can give you, I'm not an expert in mistakes, I can give you lots of quotes. James Joyce, mistakes are the portals of discovery. If those not learning from mistakes are bound to repeat them. But I wouldn't really be saying this if I was a physicist, I suspect, or potentially an engineer, or hopefully even a doctor. Mm-hmm. But in finance, sadly, we do. So there's an endemic problem in finance, and I think it's basically the incentive system. Mm-hmm. The incentives are wrong, the time horizons are wrong, and it leads people to knowingly make mistakes, to play that greater fool game, which once again you mentioned in Boom and Bust, that I know this is stupid, but I'm the one who can get out. Mm-hmm. And the more liquidity there is in the market, the easier it is to say, I know it's a mistake, but I think I'll get away with it. Mm-hmm. So finance tends to breed more of that. So I don't for a minute think that if we have a library of mistakes and I run a course with finance, that one day there won't be any mistakes in finance. We hope to make them smaller, but ultimately, as long as the incentives are wrong, I think we'll continue to make mistakes. So I think that's why mistakes are particularly valuable in this field. But I think there's a broader scope for this as well. Most people watching this will probably even have read Thinking Fast and Slow by Daniel Kahneman, a bestseller that came and Kahneman won the Nobel Prize. But Kahneman's citation for the Nobel Prize was for furthering the understanding of human decision-making under uncertainty. And of course, he studies that as a psychologist. But I think that's what we do when we study financial history and the history of mistakes. We are studying the history of human decision-making under uncertainty. And if it's good enough for that particular Nobel laureate, it's good enough for me. And it's probably an easier way to study it through financial history. So the whole thing links into, I think, a bigger thing, which is about human understanding. But I would keep coming back to the thing. It doesn't matter how smart you are. If you've got the wrong incentives, you're prone to do stupid things. I think that's why finance is prone to do more stupid things than perhaps physics or the physical sciences. And
do you think that has changed over time, that we make more mistakes now than we may have done 30, 40, 50 years ago?
I think the answer is yes. And I think the answer is partially because of liquidity, because everybody believes that they can exit their mistakes. So all of us are, there's a great book by Risk by John Adams, which basically says we've all got an internal risk thermometer, a natural level of risk that we're prepared to take. And if I am, made to wear a seatbelt, I drive faster or more recklessly. And I think once you provide this sort of liquidity in financial markets, there's a proclivity to take more risk because you think you can reverse them. And I think if I look at a lot of the things that have happened in my career, they wouldn't have been done without the liquidity, which created the illusion of the ability to escape. So that wasn't to say people deliberately made a mistake, but their risk thermometer was probably set higher because they believed there was an exit. So I think liquidity has made these things more prevalent. And I know if you're in finance, you're supposed to be a great fan of liquidity and say how important it is, but I'm not such a great fan of hyper liquidity in financial markets. I think it leads to the wrong incentives. And that's, I think, probably why we've had more mistakes. That in the 1945 to 79 period, there were fewer of these things. There were many, many more controls in finance, which is probably a different topic. Yeah. But there was certainly less liquidity, which allowed us the arrogance to believe that even if I made a mistake, I can be out of this quick.
Yes. By the way, for our listeners today, if you have any questions for Russell, please put them into the chat, and we can ask Russell those questions as we go along. There may be things that pique your interest, so please put those into the chat. Russell, we've already touched on this, but a related part of what I call the Napier approach is the important role of financial history. Okay, so what role has financial history played in your development as an advisor to investment institutions?
It's been seminal. I think there are to what I do for a living, there are two pillars to that. So one is financial history and one is trying to understand money and credit. And I suppose people watching this who are not in the business might think that that's what everybody in the business does, but actually it isn't. There are It's not a criticism, but they look at other things. Those are two things that have been left out, I would say. And the honest question is why? And a lot of this comes down to the efficient markets hypothesis, which, remember, as formulated, said that all available information is in the price. Now, I don't know what your definition of history is, but I would define it as all available information. So there was an ideological thing to take all of this out. So when I found myself facing a situation in financial markets that I didn't really understand, I would try and find a book from history on something akin to it. And it certainly helped me immensely to better understand the mechanism. And that's what I would stress about financial history. It's teaching about mechanism. I mean, everyone always says to me when they walk into the library mistakes, what's the one book I should read? It's the most annoying question you could ever be asked as a financial historian. What's the one book that has every lesson from financial history? So there are a lot of lessons. People tend not to read them. But that's why I found it useful. And I also had this bizarre situation where obviously I worked with people with a lot more experience than I had. Some of them had been around managing money in the 60s and the 70s. And I would say to them, this looks a bit like 1965 or something. Tell me about 1965. And they would say, can't remember anything about 1965. So the institutional memory is not great in finance. So I find, this is what I do. At the minute, just like, I'm writing about financial repression. You know what that is. Carmen Reinhardt is one of the leading academics on that. It's a period of history we've been through before, from 1945 to 1979. There aren't many people in the markets who lived through it. There's a few. It's radically different from what we've been through in the recent past. There are huge numbers of lessons there. And I see things on the front page of the papers every day that ring a bell. You think, my goodness, that's just like 1974. Recent comments by the governor of the Bank of England come to mind in terms of telling us all not to take a pay rise.
Yes.
So it rings a bell over and over again. And what is my job? People think my job is to forecast the future for financial markets, and there's obviously a bit of that, but it's really to educate. And if you can't educate people by using the past, what are we going to educate them from using? So hopefully they continue to find it useful. But at the minute, in particular, I would say that people are finding more messages in this, because it's likely that we're living through a great structural change in how the system works. And people are got more open minds then, because it's not just another business cycle, something different is underway. Yes. So that's how I've used it. And I'm really struck by the fact that so few people do. There are others, but it's actually a very small number. But I think it's because most of them, unlike me, were educated in a business school, John.
Yes.
So they've come to believe the power of numbers and decimal points, and not the power of history, which I know you're doing something about here. So
So something that really struck me, Russell, again about the Napier approach when I read your book, the Asian financial crisis, you have the courage to stick to your convictions. You were a bear in Asia during a huge bull market, and as you say in your book, bears get invited to fewer parties. It can be a lonely and dangerous place being a bear. So what made you stick to your convictions? What can you pass on to others who basically have convictions? How do you stick to them?
Well, being bloody minded isn't necessarily a good attribute, as my wife will tell you. Some of that may have been from being in Belfast for too long as well. There's definitely a cultural element to this, and I see that in markets. And culture becomes more clear. The more you're in the market, you realise that people's culture has a different view. So I would blame Northern Ireland for some of it, but I can't blame Northern Ireland for all of it. So it depends on what you think it's incentives and consequences. So I wasn't worried about the consequences of being wrong. The consequences of being wrong is that I would have been fired and I'd been back in Belfast being a lawyer. And to me, that didn't seem like a particularly terrible thing. So other people had other aspirations and other liabilities which had to be serviced, and therefore couldn't afford to take the risk. So I didn't mind being wrong. That's the thing. You have to think, do I mind being wrong? Obviously, I was doing it in public as well. So I was going to be putting your opinions out in public, which I've done now for 25 years. That's an interesting thing. And at the minute, I'm getting lots of wonderful emails to tell me how wonderful I am and how smart I am because of something I wrote about inflation. 5 years ago, I was getting emails saying, "You idiot, you're terrible." So you have to just roll with the punches. And that, I think, is partially character and culture. I don't know if you can learn it, but it helps not to have large liabilities when you're not concerned about your future job prospects.
Yes, absolutely. Okay, so for many of our listeners this afternoon, they won't remember the Asian financial crisis. I remember it because I was writing a PhD on the history of financial crisis and financial regulation in 1996, 97, 98. And so it was very much at the forefront of my thinking. But for our listeners who are too young to remember it, you can tell us just briefly, what was it and how severe was it?
So let's just talk about the stock market first. So if you put money into the Indonesian stock market, for instance, you lost 90% of your money in dollar terms. That might sound like a lot, but it was not the most important thing that happened. 1,000 people died in Indonesia through riots. Indonesia has a delicate racial mix. 1,000 people died. Some people died in Malaysia from riots. The president of Indonesia, who'd been in office since the 60s, was catapulted out of office. So this was a big thing. And it wasn't just Indonesia. It was Thailand, Indonesia, Philippines, Malaysia, got to Korea, which was very, very important, and was slightly on the verges of Taiwan. The impacts for that rolled on globally to Russia, where a nuclear state went bankrupt, which we thought was impossible. It brought misery to Brazil and it forced Argentina through a very prolonged deflationary episode as well. So this was a global episode. It bankrupted a famous hedge fund in New York with two Nobel laureates in it called LTCM. It looked like it was bringing it to the doorstep of the US financial system, and then it didn't. And that's kind of one of the worries, why it didn't. But it's largely forgotten because of what came after it, the great financial crisis. But I can assure you by September 1998, there were many people in the world who thought this was the beginning of a new Great Depression. And all that's gone now, but it felt like it. And it wasn't just me. I mean, the people in policy circles will tell you they really thought the entire global financial system was coming back because of the repercussions of what happened in Asia, its impact on their competitiveness, its impact on financial stability, seemed at the time about to change the entire world. And I argue in the book it did change the world, but in a very different way from the one that we expected it to do at that time.
It's really interesting because Martin Wolf in the FT yesterday was reporting on a World Bank survey looking at the great events that have affected poverty over the past 40 years. And over the past 40 years, there's only been two events that have increased the poverty around the world, the number of people in poverty. One was the pandemic that we've just lived through. The other was the Asian financial crisis, 97, 98.
I lived through that, and I was based in Hong Kong, but I was still traveling around the region. And there was a point the Indonesian exchange rate fell so far the Indonesians couldn't afford food. Now, coming from Belfast, this obviously rings a few cultural bells of the potato famine. And what was shocking is that the answers that were given were the same, as you know, from the economists who were around at the time, which was, don't worry about it, the price of food will go up. This will drag in more food to Indonesia and everything will be fine. Well, the people didn't have any money. And we were getting a rerun of these arguments. So when we talk about poverty in this country, we mean one thing, but when you talk about poverty in Indonesia, you're talking about people not being able to eat.
Millions of people.
Yeah, now the people in Indonesia didn't starve to death. Those people who died in riots. But had the intervention not gone the right way, there's every possibility that many people in Indonesia would have died of starvation. I mean, the exchange rate stabilized, the exchange rate strengthened, not back to where it was. Interest rates came down, inflation came down, and it went right to the brink. And I've forgotten the population of Indonesia. I think it's 120 million people. I mean, it's a huge country, people forget. So when I think of the Asian financial crisis, I think of these countries, not the ones that most people think of, like Korea. I think of that country because the consequences there, and also the social, political, and the strife between the indigenous population and Chinese population. It could have, and in the 60s, it had been a murderous place. And sitting in Asia in 97, 98, you thought, this is the year of living dangerously all over again, and the consequences of this. And I think that's the interesting thing about our business. We kind of think it's esoteric. But on the ground, as you say, this had huge implications, which we've largely forgotten. But it came right back from the brink. It really was touch and go.
So what were the underlying causes then of the Asian financial crisis in your view?
It was this will sound perverse given I've just said it's this huge thing, but it was the wrong monetary policy. And it was far too much credit expansion. What do I mean by the wrong monetary policy? Because you'll say, if I say to you the Bank of England's got the wrong monetary policy, it doesn't mean to say the whole thing's about to collapse. The problem for Asia is that the monetary policy they chose was to manage their exchange rates against somebody else. So people watching this might be familiar with Greece. This is what the euro is, and Greece found itself in this trap where it couldn't kind of inflated its way out of it, had a massive debt burden, and the Republic of Ireland was the same. Interest rates couldn't really be changed that much to alleviate it. Now this is what Asia had done on a much grander scale, because they were much bigger places and much bigger countries, and it extended right into North Asia, Taiwan, Korea, all the way down to Indonesia and the Philippines. Now, when you choose that monetary policy, you're effectively, we can go through the mechanisms if you like, but basically you're handing the control of the supply and price of money to somebody else. It's entirely based on the condition of your external accounts if you're going to manage your exchange rate. And then they just hit with this wall of money. So we mustn't forget that we participated in this because we had, actually it wasn't that long before, opened up the capital markets and allowed the free movement of capital. And that capital just hit these countries, and they had no option but to print money. If they were not going to let these exchange rates go up, to print money, and the bankers took that money. And across Asia, we had bank lending growth. It was usually 25 to 30% per annum. Now, I question anybody watching this to walk into the street and find 25 to 30% more people every year to lend to, and find good people to lend to. So you had this great credit bubble underway, which they really couldn't do very much about. We can talk about the exceptions to Hong Kong. The way you could do something about it was really through bank regulation, but you couldn't do anything about it through the price and quantity of money. So it was an abject lesson in the dangers. I mentioned this when I had this conversation with a French Senate at the time about what might happen if you put the euro together. It's the abject dangers of pegging your currency to somebody else, giving up your monetary independence and putting it onto autopilot. And of course, I keep going back to your book. The politicians loved it. I mean, who doesn't love excess money? Who doesn't love excess credit? Who doesn't love booming prices? So the mistake of the politicians was to peg the currency. But then the real mistake was actually when it was obvious, and it was obvious, lots of people were writing about it, it wasn't just me, lots of people were writing about it, the scale of this. They didn't have the guts to do anything about it, because politically, everybody was benefiting from it. Once again, I think of the Republic of Ireland and Bernie Ahern's famous quote to David McWilliams, people like McWilliams should go and commit suicide, because McWilliams was pointing out some of the excesses. So to be fair to politicians, it's very, very difficult to pull the plug on a great big boom. And it wasn't up to the central bankers in this case. The decision to link the currency was a political decision. The central banker couldn't do anything about that. His hands had effectively been tied. So it was even more dangerous, because hopefully central bankers are a little bit more politically independent, but the politicians couldn't stop it because everybody was getting so rich now in such a great time.
And also, like, where was the role then of international institutions here in terms of, think of the World Bank, the IMF, pushing sort of deregulation on these economies, which meant that all the money was coming in that they were lending out to, property developers, to those buying stocks, to people speculating.
So we opened up the markets, and what I mean the capital markets, and these countries couldn't cope. They were too small to cope with the scale of capital that was available. And of course, there's two sides to that. We had all these institutions, and these institutions were basically developed world banks, who were also being deregulated. Now they wanted to lend money, and they saw the growth rates of Asia, and they saw the growth rates of Europe and the United States, and thought, this is where we need to be. So there were two sides to it. They suddenly found themselves able to go and lend, and they sourced. If they didn't have dollars, and many of them didn't, if they were Europeans, they sourced them in the euro markets, which were now massively larger, and that facilitated dollar lending across the planet. And they lent them into these countries where 20 years before it would have been impossible to do that, because of capital controls and restrictions on the free movement of capital. So this, Mr. Soros calls it the wrecking ball of global capitalism. We're kind of back to this liquidity issue again. Can small economies really cope with liquid capital flows? They, I think, can cope with illiquid capital flows. Foreign direct investment is the best example of that. Once it comes in, it gets into plant, machinery, and equipment, doesn't rush back out again. But the type of capital which Asia was relying on, and this is one of the things I look at in the book, one of the key indicators that this was coming to an end is the composition of the capital flow. It had gone from being foreign direct investment long-term to very short-term portfolio flows. So I think the problem, in my opinion, is we need to slow that down. And there have been some countries, Chile in particular, which has had a form of, speed bumps, I would call them, not restrictions, speed bumps in the pace at which money can go in and the pace at which money can come out, which I'm not a fan of capital controls, but I'm a fan of speed bumps. And people might think I'm mincing words here, but I think these speed bumps are useful. Brazil used them in 2013 to stop people getting into their bond market. And I think they are the new normal. They will be the new normal anyway. So I think one of the lessons of that is that small countries really cannot cope
Yes.
with the scale of the capital inflow. We're taking the entire savings of the developed world and trying to put them into small equity markets, and there are consequences of that. If you're managing the exchange rate, if you're not managing the exchange rate, the consequences are your exchange rate goes up to very dangerously uncompetitive levels. So you know that the IMF has changed their mind now.
Yeah, absolutely.
And then one of the things they do, and I've been to the IMF to talk about this, is that let's just say, I don't think the IMF will be against speed bumps if countries begin to introduce them in the future. And I don't remember them being particularly against the Brazilian speed bumps of 2013. So that will be the new normal. Yeah, this is not where the story with the IMF ends, by the way, but in terms of the Asian financial crisis. We'll hear from them again. But there's no doubt that the liberalization played a role.
Okay. So we've already touched on this to some extent when we were talking about Daniel Kahneman's work. But thinking of crowd psychology and what Charles Mackay called the madness of crowds. So you had that front row seat. What role did the madness of crowds play in that boom in Asia? And how can then we vaccinate ourselves, if you like, against the madness of crowds?
Well, the second question is much more difficult than the first one. So I think it's there are so many ways that it become a madness, but it's liquidity in things that shouldn't have liquidity in them, which I find particularly peculiar. So there was a very active, I don't know if you know much about Chinese burial practices, but it's really important if you're Chinese to have a burial plot in the right place. There's a really, really active secondary market in Chinese burial plots in Malaysia. There's a big secondary market. You could go and trade burial plots. And when we're looking, I think what you're looking at and what Mackay covers in the book is something that's kind of spreading from a narrow section of society into a much broader section of society. And I think that's what you look for. I mean, famously, John Kennedy's father mentioned the shoe shine boy giving stock tips. For me, it was the Malaysian trading burial plots. In 1993, I was coming through Kuala Lumpur Airport. I had a big pile of research, and I was stopped. You put your stuff through the conveyor belt, and this guy saw this, and what on earth has he found? And he said, "Actually, you've got all this research." He said, "Give me a stock tip, but you're not getting through." That sort of thing. So those are subjective. I'm not sure to what extent you can. By definition, the madness of anything can't be put into purely objective terms. It's quite subjective, but I think it goes broader through society, and you see liquidity in places where it shouldn't be. As to how we inoculate ourselves, well, I mean, I to the extent that I am inoculated, and we're all fooling ourselves that we think we are, I think it's through reading financial history. I can't really think of another way to do it. I mean, you have to be keen not to follow a herd. I don't know where that comes from. But there are people, smart people, who make a lot of money who definitely follow the herd. I mean, they are a different kettle of fish altogether. They see it and they think they can run it, and they can time it. And I think some of them do, but not many of them. It's not me. I certainly don't get involved in that, and I don't think I've got the skill set to do it. One little tip from a man called Gordon Pepper, who I've worked with for years, and Gordon was a very famous strategist in the 70s and 80s and was an advisor to Margaret Thatcher. He was teaching a my course one day. He just made this up off the top of his head. Someone asked him a similar question. When I see this happening, what do I do about it? And Gordon's answer is you use every rational power that you have to work out how long you think this thing can be sustained, and then you double it and take off a month. Now that to me is as an accurate on gauge as any as to when you can work out when one of these things is going to end and provide yourself with some inoculation. And you take off a month just to be on the safe side. But they always last much, much longer than you think they are. And of course, if you ever point out that they're going to end, you get abuse, as I know from my regular columns in Toronto Star on crypto.
Well, so my co-author, Will Quinn, has very strong opinions on crypto and has got a lot of kickback from crypto enthusiasts. There almost is a madness of crowds and really defending their positions. And I think I knew there was a crypto problem when my brother was giving me tips of to invest in Dogecoin, and when my son was telling me to buy NFTs, you begin to sense that there is this problem. So one of the things that Robert Shiller, the Nobel Prize winner in economics, has really emphasized a lot recently, and has a couple of recent books on this, is a role of narratives in fueling the economy, but particularly in fueling stock market booms. So what was the dominant narrative when you were in the market back in the 90s? What was the dominant narrative about the Asian tigers?
Yeah, the dominant narrative was really simple. These countries had much higher levels of economic growth, therefore they would produce much higher returns from the stock market. That was it. There were some subsidiary stories going on there. One of the subsidiary stories was about Asian values, that Asians were natural capitalists. But let's talk about the first one, because we know as the financial historians that there is no relationship between the rate of economic growth and the return you might get on equities. But it was there, and I show it in the book, because we had this bizarre situation with British pension funds, which were then more defined benefit than defined contribution, had more money in Asia expat equities than they had in America. Now, we both know the respective size of those markets today, but even then the respective size was really, they were completely out of kilter. And if you asked a asset allocator in the United Kingdom, why do you have more money in Malaysia, Hong Kong, and Singapore combined than America, they would say, well, they're growing faster. That was the rationale. But what the fascinating subtext of this book is, as all of this was happening, America was getting these new companies. One of them was called Netscape, which a lot of people in this will not even know ever existed, but it was blazing a trail for the internet. And of course, Amazon came along during this, and suddenly one of the great lessons in financial history was taught. When you're investing in the stock market, you're not investing in the economy, you're investing in companies. And it turned out that Asia's growth was a bit of a paper tiger anyway, but even had it not happened, it wasn't going to produce good returns the way Amazon was going to produce good returns, but ultimately relying on companies. So I think the prevailing myth was invest in a high growth economy and you will get high returns from equities. My favorite example of that is I was there when China listed its first ever stock available for foreigners in the modern era, which was 1992. Morgan Stanley then produced an index of all of these stocks. They're called B shares from 1992. So as everybody watching this knows, China's done quite well since 1992. So that's 20 years of data now. This index, is just biased towards this handful of what they call B stocks, is gone down over that period. So you put your money in 1992 into the biggest growth thing that's ever happened in the world, and I mean that there's been nothing like it. Even America, there's nothing like that 20-year period, and you didn't make any money. It's because you're investing in companies. And I went to these companies. Not only did I go to them and see them when they came to Edinburgh, I tracked them down in Shanghai and went to them. Property companies, and they missed out on the Amazons of this world because of that fallacy. The fallacy of the high economic growth produces good returns on stock markets
or in property markets, as we learned with the Celtic tiger. So we start from the Asian tigers, we move to the Celtic tiger, and then high growth economy. Therefore, asset markets are going to do well, property is going to do well because of that. It's a similar sort of.
Absolutely. And you just, through all that, you ignore the way it's financed. The focus is so much on the growth that you ignore the growing poor quality of finance that holds the whole thing together, which is exactly what happens. So it doesn't matter whether that's equities or property, and that's what you've got to focus on. You've got to look at how this stuff is financed, who's doing the borrowing, terms, conditions, etc. And the looser it gets, the more you're in trouble. And property is often the thing that brings it down, because the banks use that as collateral. There's not many banks using a lot of equity as collateral, but they use property as collateral. So Asia got both. They got a collapse in property, and I got a collapse in equities.
As well. So we've already mentioned China here, but China lurks almost in the background of your book to some extent. And in the mid-1990s, their pivot towards this export-led growth model that the Asian tigers had been using, that Germany had been using, it was underway. They'd switched from agriculture, they brought people into the factories, manufacturing was built up ahead of steam. They devalued their currency in 1994. So there's you standing in 1996, 97, 98. Did you imagine that China would become the economic superpower that it is within, as you say, within a matter of a couple of decades?
No, I didn't. And when you went to the presentations for these companies, they usually began with a forecast for Chinese economic growth, which, when a broker is selling something, John, they tend to be slightly overly optimistic. Let's just be As using euphemism like that. But you know what? They were all far too conservative. We all sat and scoffed. So you think there's going to be 4% real growth for 20 years? You really think that's going to happen? You're just a stockbroker. And China shot the lights out of that. So that was the stunning thing. So I don't think whoever you speak to could tell you that they saw this could happen, because nothing like it ever happened before. So no, we didn't see the scale of this. Now, there are lots of problems inherent in it in terms of the structure and the way China has achieved it. But I don't think anybody can tell you with a straight face that at this level, there may have been people who were bullish, but nobody saw this level of real economic growth coming out of China. Know the size of its external accounts, its external surplus, know the size of its foreign exchange reserves. And I mentioned those two things because they obviously then had huge impacts on the rest of the world. It was a China story, but it's a China story that actually changed the whole world in 20 years.
Yes.
30 years.
Is there any sense in which, so you think of the Asian tigers and they've got the export-led growth model going on, and then China comes and almost gazumps them?
But it's sort of what happened. So China devalued in 1994. I mean, people in the markets then weren't stupid. There was a prospect that it would be very difficult for everybody else to run the export-led model then, because China was probably very competitive. But the interesting thing is, if you look at the stock markets, they basically go sideways in 1994, 1995, 1996. And the market was kind of looking into this and saying, well, will China actually do this? Won't it? There were some people who argued that China would undermine competitiveness, but there wasn't any conclusive evidence. I think, and I think it begins to appear towards the end of 96 that China's doing this. Because remember, when China devalues, of course, there's a lot of people, but it has to mobilize them, and they weren't really being mobilized, but they got mobilized incredibly rapidly. That was also Deng Xiaoping's tour of Guangzhou contributed to that. So in the initial devaluation, lots of people said this is going to be a disaster for all of the emerging markets in Southeast Asia. But then it wasn't for a couple of years. So it's a bit like the roadrunner going off the edge of the cliff. And then suddenly we looked down and there were Asian exports falling. And we knew they'd been investing a lot of money. The idea was they were investing a lot of money to build lots of capacity. And there'd be an export boom, and a year went past, and 2 years went past, and it was almost like that roadrunner moment when suddenly we realized that actually, I think I mentioned in the book, Chinese exports to Japan were growing at 30%, and Malaysian exports to Japan were going down by 10%. That was kind of pretty good evidence that whatever China had done, a combination of a devaluation and mass mobilization of resources was really paying off. But it took a while for the evidence to be there. And the people who had claimed it in 1994, many of them were fired before 1997 came along. Thinking too early. And too early in this business is wrong. And so that was it. We did ask the right questions, but there was not enough patience there to sort of realize
just the scale. Would you say this is unprecedented in history? Like 9-10% real economic growth over more than 2 decades.
America mobilized a lot of people. They all went by ship, a lot of them went from here. But nothing in the way the Chinese mobilized these, well, they call them peasants, farmers. The way they brought farmers in like that, that's never.
The rate of urbanization from 10% to 50% again across 20-25 years. That took place. Again, folks, if you have any questions for Russell, please pop them into the chat, and I can ask him those questions. So a couple of things that come out of your book are the interrelated issues of high turnover financial assets, short-termism, and we've already talked about hyperliquidity. So why, and this is where I fully agree with you in your book, Russell, is these things are a problem. So can you tell us why you think they are a problem, and why have they emerged?
So it has to be incentives. The annual bonus doesn't help. I think it's a disastrous innovation, the annual bonus. We have an important job to do in our business, which is to allocate scarce savings. The idea that you can allocate those scarce savings and then remove them within a year seems to me to be to thwart. I mean, I don't know what Adam Smith would call this, but I really don't think he would call it capitalism. I know people watching this might think that it's capitalism, but I think it isn't. So somehow we've got to have time horizons that match the end consumer. Our both savers. I don't know when you're planning to retire, but I'm hoping to go for a bit longer. Our time horizons are reasonable. I mean, our children's time horizons are 30, 40 years for these savings. But we have an industry that can't really see past 12 months. So we've got to do something about that. And it'd be nice to think that the industry was capable of doing it proactively, but unfortunately, probably it isn't. So when we've had longer time horizons in the past, I think they've been kind of forced upon the industry. I don't think the industry volunteered for them, and we might unfortunately have to go back to that. So it's I have an oversimplified answer to all of these questions, which is the incentives in the industry are wrong, so you'll get the wrong outcomes. And I take that from Charlie Munger, and what a better man to quote than never ever think about anything when you should be thinking about incentives. Pass all the legislation on the planet to try and change things. But if it doesn't fundamentally change the incentives, and I don't think it's rocket science, I think it can be done. So I'd love to think we could educate everybody better and everything would be fine. But we've got to get longer term time horizons in investment, or we'll keep doing this over and over again.
And then one of the other developments that really has taken place over the past 20, 30 years is the rise of sort of passive investment industry. Okay, that complicates things.
Yeah, so I mean, I know why the consumer likes it, but society has to think about what it means. And I think the societal impacts of that are dire, absolutely dire. So you've got this horrible problem. I mean, I don't actually have any of my own money invested in passive products. I'm arrogant enough to think I can find smart fund managers to look after it for me. And sometimes they do, sometimes they don't. But just think of the consequences. You can just go back to Adam Smith and let's say he's sitting over here, and I explained to him that the way we allocate savings and capital today is we find a corporation with a large market capitalization and we give it more capital. That's kind of silly, isn't it? I mean, that's not what you're supposed to be doing. You're supposed to be trying to find the management or the entrepreneur who can take this capital and grow it. You're not supposed to be looking for someone with a large market cap that you can give more capital to. And the capital markets are broken. We discussed why they're broken in terms of incentives, but this passive investment thing has really broken them. They don't fulfill the role they're supposed to fulfill. The stock markets in particular are not really venues where people raise capital for investment in anything. That's not what they've become anymore. They've become something else. Remember the great quote from Keynes about when speculation is merely bubbles on the strong flow of enterprise, then it's perfectly okay. But when the bubbles become the enterprise, then things are very different. Well, that's kind of what's happening in the financial markets. They're not this place where you source capital for investment. So I'm not saying they're not entirely devoid from doing that, but they've gone away from that. And this indexing, the ETFs, that doesn't help at all with any of this.
Would you say it's a larger problem in some economies than others?
Yeah, I'm sure. I mean, there's some economies where the cost of capital in the stock market plays a role in business, and there's some where it really doesn't because the stock market's too small, it's not influential enough. So obviously America would be the bigger one, and then there's the incentives again. I mean, I'm sure you've read Andrew Smithers' Productivity in the Bonus Culture as to how this the ability to get your share price up as a corporate manager is probably more important than to make excellent long-term allocations of capital. So there are definitely some countries where this is much worse than others.
And with CEOs such as the CEO of Apple in line for a $99 million compensation package, sort of goes to this very, very question. So the title of your book, and I suppose my main takeaway from your book, is that the Asian financial crisis created this global financial architecture that then produced the biggest debt boom in history. So can you tell us a little bit about what you mean by that?
Yeah, sure. So the China divided in 94, this crisis begins in 97. Most of the Asian countries devalued in that, certainly the big ones. China didn't, but Korea did. Like Korea was a huge economy, a big export-oriented economy. So suddenly you've got not just China with a very cheap exchange rate, you've got all these others as well. And they did intervene to stop those exchange rates rising again. That was the important decision that was made in the second half of 1998, and nothing was done about that. Now the consequences of that were, of course, that they sold a lot of stuff very cheaply. So it kept inflation down for you and me and everybody else in the developed world. By keeping inflation down, it kept interest rates down. But it didn't particularly negatively impact growth in the developed world. I suppose that was a bit of a surprise for most of us. That growth in the developed world continued. Perhaps these lower interest rates were doing it. Certainly the central banker of America at that stage, Alan Greenspan, was very keen to keep the thing moving along by cutting interest rates. So you had a sort of wonderful situation where imported disinflation, lower interest rates, more credit. People responded by taking on more credit. The way you keep your currency down in one of these regimes is you buy a lot of foreign securities, and particularly United States treasuries. That freed up American savings. We didn't have to fund the government to go and fund something else. like the stock market. So there's a whole host of things which really, really encouraged people to take on more debt. I think the LTC, I was lucky enough to know Paul Volcker. And the first time I met him, I asked him a very cheeky question, which was, where did it all go wrong? Which was as cheeky as you can get. He said LTCM. So once again, that was a hedge fund that collapsed. Yes. It wasn't that there was a bailout put together for that for banks. It was that the central banker cut interest rates. And suddenly everybody in the markets went, wow, if someone in the markets gets in trouble, the whole monetary policy of the country can be changed. Not just that we can find a bailout over here, we can actually change the whole monetary policy of the country just to bail us out. And I would argue, and I argue in the book, that the same thing happened in '94 with Mexico and Robert Reagan's intervention there as well. And so apart from all this low interest rate stuff, you now had a thing, well, you can't lose money because, you know, these guys are going to bail us out. They bailed us out in '94, they bailed us out in '97, Greenspan cut interest rates in '87. And that was all started here. It didn't start with the GFC, it was all started here. Yes. And that was the basis for the huge growth in debt that we've seen. And the growth in the debt to GDP ratio is now at an all-time high. We don't have data for this, maybe you do, going back to 17th and 18th century. But I would argue, based on at least data going back to World War II, that in public and private together, we have never seen debt to GDP ratios at the level we have today. And I think it's a direct consequence of the crisis, but also the mistakes that were made in building the architecture that would come after the crisis. I mean, I wanted to read something on that actually because it was a speech by Bill Clinton, so it's pretty appropriate for what was going to happen. Next. So in October '98, the IMF annual meeting was in Washington D.C. and Bill Clinton made a speech at that meeting. And the whole world looks like it's falling apart. And this is what Bill Clinton said: "If we're going to have a truly global marketplace with global flows of capital, we've no choice but to find ways to build a truly international financial architecture to support it, a system that is open, stable, and prosperous. To meet these challenges, I've asked the finance ministers and central bankers of the world, leading economies, and the world's most important emerging economies to recommend the next steps. There is no task more urgent for the future of our people, for at stake is more than the spread of free markets, more than the integration of the global economy. The forces behind the global economy are also those that deepen liberty, the free flow of ideas and information, open borders and easy travel, the rule of law, fair and even-handed enforcement, protection for consumers, a skilled and educated workforce. Each of these things matters not only for the wealth of nations, referencing Adam Smith, but to the health of nations. If citizens tire of waiting for democracy and free markets to deliver a better life for themselves and their children, there is a risk that democracy and free markets, instead of continuing to thrive together, will shrivel together." I think it's like a great echo to where we are and the mistakes that were made here, because he said we will get these people to build a new financial architecture. Wasn't done. Now, sometimes the political capital to do these things just evaporates, but for whatever reason, it wasn't done. And instead, we set up the system that we've run with for the last 20, 25 years, which I think in many ways has created what Clinton said here. If citizens tire of waiting for democracy and free markets to deliver a better life for themselves and their children, there's the risk that democracy and free markets shrivel together. 1998.
Kind of worry.
So Russell, there's been quite a few questions come in here from people who are watching. So let me just we can answer some of these. So what's your view on share buybacks? Corporations using their capital to buy back their stocks. I think you've already alluded to it. It's not pretty good, but do you want to say anything more on that?
Yeah, I don't think that's a decision that should be made by corporate management. I think that's a decision that should be made by shareholders. So there are ways that we could get the tax treatment correctly, but that would come via dividend, and then the shareholder can make the decision. And that is the job of this. I mean, we're in a world of professional capital allocation. That is their job to do that. So I'm not in favor of doing that. And of course, it leads to, if we didn't do it, there would be less financial engineering, because a lot of people are using debt to buy back their equity as well. And we have it all stems from tax treatment. We have this hugely beneficial treatment of debt from the tax treatment, and that feeds in with this to give you this, I think, horrible feedback loop. So let corporates, if corporates have no need for capital, let them return it to the shareholders and let the shareholders make this decision, rather than forcing it into their own shares.
Yes.
And we know that stock options provide some incentives for them to do that.
So a question here. It's around China, and China's the biggest credit expansion of all time. We know what follows, but how and when will the Chinese correction unfold? So Evergrande was a tip of the iceberg, possibly. What's then going to be the impact on Chinese people, on geopolitics, etc., when the bust comes?
So the BIS have done some really great work on creating what they call early warning indicators for busts.
Mm-hmm.
And as the questioner alludes, what they look at is the rate of growth of debt to GDP relative to trend.
Mm-hmm.
And then they have red, amber, and green. And the flashing red for years now has been China, because there's just never anything like it. And the reason they have that early warning indicator, it's the only objective measurement that they think works. So you and I have discussed lots of things that might work, but we're fairly objective. And a lot of them are focused on credit anyway, and bank credit. But they've got something that's pretty objective. And on that criteria, China's been riding for a bust for a very long period of time. My opinion is that it's getting very, very close to this rolling overnight. We discussed in the context of the Asian economic crisis what happens if you manage your exchange rate against somebody else's. Well, the Chinese are doing that. Now, they're doing it in a much looser way than they used to, but they're not fully in control of their monetary policy. They have unique tools that the government has maintained from the command economy system, which is control of the banking system and capital controls, which gives them much greater flexibility. But in my opinion, I've just written something on this, it's given them flexibility to extend the credit and to extend the cycle by using even more credit to take it to an even more dangerous position. Most of my clients look at their ability to use these tools to extend the cycle to say they can always extend the cycle. But I guess if you're a financial historian, you sort of see the consequences of extending the cycle. So I think they're heading for a debt deflation. I mean, if you look at what's happened over the last 2 to 3 years, where interest rates are relatively high by the standards of the world. Inflation isn't ripping through China the way it is elsewhere. The economy is constrained. The external accounts, hard to tell with external accounts now because of COVID distortion. But I don't think they're healthy. I really don't think that the Chinese are competitive. And one of the things I learned in Asia is look what the locals are doing with their money. What are the locals doing with their money? And they're trying to get it out. If they can get it out, they get it out. Now, as you know, it's not that easy to get it out. There are lots of illegal ways to get it out. But I trust, when it comes to what's happening with money, trust the locals. The best people who allocate capital in the world are poor people, people who haven't got a lot of money, because they take care of it. And I mean, teachers, Chinese teachers, and people who haven't got a lot of money are desperate to get it out of China. That relates to 2 things. One is they don't think the return's going to be very good. And then they see political risks that maybe we see or don't see. Now, a country that is over indebted with a managed exchange rate that sees a capital outflow, that is the Asian economic crisis. That's what it is. So I'm very concerned that China's on the edge of that. So Evergrande to me is the tip of the iceberg. Like to be clear, there is a very simple and easy way out of it. You just devalue the exchange rate and print as much money as you want. And I think that's the one they will ultimately have to take. But as to when they get there, I don't know. But I think time, the sands of time, to quote the famous History of England book, History of the Bank of England book, I think the sands of time are running out on that one, and they will have to get to printing more money to try and deal with the debt deflation, which I think is becoming more evident by the day.
And then this was the spillover effects for geopolitics. And the role of trade in geopolitics as well. Yeah,
so that's really important because most fund managers say, well, that means massive deflation. Chinese exchange rate falls, they'll be selling lots of cheap stuff. But I think you asked the right question. Geopolitically, is that acceptable? And the answer is no. It simply isn't acceptable. You can't have China resetting the clock. Every 25 years, we're competitive for 25 years, and then we're uncompetitive, we reset the clock. And let's remember in 1994, when they devalued, they were a tiny economy. This was a huge economy, at least the second biggest in the world. Some people would argue the biggest in the world. I don't think so, but some people would argue that. So they're not going to get away with that. There will have to be geopolitical repercussions, and that's usually tariffs to try and make sure that this competitiveness is not garnered. I think the bigger geopolitical thing is that, let's say I'm running Malaysia. What do I do when China devalues? I mean, I'm now very uncompetitive. Do I seek to devalue my currency in line with China? And what do the Americans think if I try to do that? And the reason this is so important is that there is a Cold War developing, and most people, quite reasonably, would prefer to sit on the fence and not take a side in this. And the Prime Minister of Singapore said this about 3 years ago. He said, sometimes it's good to be friends with both sides, but it's not always possible. And I think the movement of that exchange rate would force people to sort of choose. Cards would be on the table. and choose. So we may think of it as a economic thing, but I think in geopolitics it's going to be much bigger than that.
Yeah.
It's going to be a clear dividing line. It's it's that moment when the Iron Curtain or the bamboo curtain finally does come down. And there will be a non-aligned movement, I'm sure. But as with the last non-aligned movement, it probably won't be very big.
So some of the other questions here. So someone's asking about the library of mistakes. Do you plan on opening additional libraries around the world?
Yep, I'm desperate to open them. Anywhere you want library mistakes, let me know.
Okay, so
we can do that. London, but I will tell you one humorous story about trying to open library mistakes. I went to, and I won't mention any names here, but I was in Manhattan, and there was a very nice venue in Manhattan that I think should have a library of mistakes. And I was having lunch with the chief executive, and I wasted a whole hour pitching the library of mistakes to him. At the end of that, he just looked at me and said, "Son, this is Manhattan. We don't do mistakes." So you need a certain amount of humility to have a library of mistakes. I think Manhattan's out, but London might still just creep in, John, with sufficient humility. But if anybody wants one, I can't say I can finance it, but I can. We can see what can be done in terms of who can have a library of mistakes. The world needs more libraries of mistakes.
So this age of debt that you talk about in your book, and that the Asian financial crisis kicked off. Well, we just lived through COVID-19, and we've seen governments increase their debt. We've seen increased central bank financing. The debt boom seems to continue unabated. How does this end for the UK? How does this end for the United States? Can we think of the current high inflation rates prevailing in the US and Europe as a way of trying to deal with these debt ceilings?
Well, we could discuss this. I'll tell you the 5 ways I think you can end it, and then if you can think of any more from financial history, you can chip in. So you could go for austerity, where particularly the government just doesn't borrow anything and actually pays back debt. You can go for hyperinflation, where you could just destroy it. You could go for very high levels of real growth, which I don't know if that's actually within the control of government, but that would be a fantastic way out of this. And then you can go for financial repression. I've missed one somewhere. And default. That would be the last one. I think that's it. I think that's the 5 ways you can do it. If you can think of others, let me know.
Some combination.
Or a combination
of those factors.
So that's it. So everybody watching this has to think politically, what's the choice? Not economically, politically, what's the choice? So the combination of those factors that I think is highly likely, what we call financial repression, which is to keep that inflation rate high and to keep interest rates low. And over a prolonged period of time, as we did from 45 to 79, your debt to GDP ratio comes down. That's it. Now that's a world where you're moving wealth from savers to debtors. That's it. So that's the world that we live in. That's the way it will be done. But it is important to say that's not hyperinflation. It's not hyperinflation. And as an academic, you'll know there's a very distinct definition of hyperinflation. I think it's 50% a month, something like that. And the word hyperinflation is bandied about all the time in my business anyway. So I would be surprised if it got above 10%, but I'm not. I think it'll stay above 4% for 10, 15 years. I think it's a policy choice to try and achieve that. And I see policies put in place every day that I think are aimed at achieving that level of inflation. And I've been calling it for years. I've been calling financial repression, stealing money from old people slowly. It is important not to tell everybody about this and hope that it's surreptitiously. In many ways, it has already been underway for 10 years. If you think about what you've been getting in your deposits in your savings account, it's already been underway. So they're doing a reasonable job. They will be doing a reasonable job of it if the debt to GDP ratio was coming down, but it isn't, it's going up. So we'll just have to try harder. So I think higher inflation is the new normal as the most socially acceptable way of doing it. It's not that it's socially acceptable, it's the most socially acceptable way of doing it. So here we are.
I suppose major economies got their debt burdens down after World War II, as you say, through financial repression, running keeping interest rates suppressed, keeping inflation up at a certain level, not too high, but just high enough. But also the economy was growing.
Sure.
Where, and this is the big question, of course, for the West, productivity, is it on the slide? Is the economy going to grow? And so if the economy doesn't grow, then getting this debt burden down to an even more difficult problem.
It's the most important one, because the fundamental difference when we ended World War II, we ended World War II with no private sector economy, basically. It was a command economy. So you could unleash this thing And we ended World War II with very limited debt in the private sector. There's still a few debentures in the corporate sector, as you know, but not a lot of private sector debt. We are now sitting with huge debt in the private sector and the corporate sector. And you can't say, what was the dream of the man in the street in 1945? It was to own his first ever automobile, to go down and get a hire purchase and own that first ever radio. That's not where we are. I mean, you can unleash, if you like, if you think of post-war America, famously, you unleash the consumption that just exploded in a whole new ways. That was the consumer society. We sort of tinkered with it a little bit in the late 20s. It certainly wasn't around in the 30s, and we unleashed that. And that's where the growth came from. And it is difficult, certainly in the developed world, to see how we can unleash that as a level of growth. And you can. So it may just mean the repression. My conclusion is repression has to be even harder.
Yes.
It has to be even more determined.
Yes.
That the gap between interest rates and inflation has to be even bigger.
Yes.
Because we start with this huge debt burden in the private sector.
Yeah.
And I was on I did an interview with a gentleman called Lacey Hunt recently, who's a very well-known economist, and he thinks the conclusion of all this is lower real growth. And I think that's probably true. That's the problem. But to get your debt problem down, higher nominal growth is probably enough.
Yes.
And we did find that lesson after World War
Yes.
II. It took a long time, but eventually by 1966, Ian MacLeod was able to get up in the House of Commons and talk about something someone had never heard of before, stagflation.
Yes.
We'd never seen it before.
Yes.
And I think that's where it does lead you to. It's just, and I think we'll get there quicker this time because we haven't got that pent up growth.
Yes.
So we're not looking at a great revolution, and we will see a huge boom in real growth, obviously, in the short run because we're recovering from COVID. But I think we are looking at pretty poor levels of real growth, which may just mean they need to run the nominal and the inflation a bit higher to achieve these goals.
Well, Russell, our time is gone. Thank you very much for sharing all your insights. Thank you very much for coming and talking to us about your book, available at all good booksellers and Amazon, The Asian Financial Crisis. I highly recommend it. Thank you very much for joining us today at this long run in conversation with series, and we will be in touch in the future about our future in conversations. So I hope you enjoy the rest of your day and your afternoon. So thanks very much for joining us.